Hey, good morning, options traders, and welcome to all of the new traders. We've had quite a few this week, so it's great having you here. And I wanted to talk a little bit about why historic volatility collapses when markets rise. I got a lot of questions about this, especially after the Corona crash. And people were saying, well, we had virtually the same drop and virtually the same rise in the same amount of time. You would think that the volatility calculations would produce the same volatility. But if you look during those times, they were vastly different. So what I want to show you is just to understand a little bit about the calculations and why just because you see collapsing volatility doesn't necessarily mean that you're out of the woods. So to start, remember that there are really two basic volatilities. We have implied volatility, and that is created by perceptions of future volatility. What will the volatility be in the future? And that's what the traders are bidding on with the extrinsic value. That's where the extrinsic value is coming from and the implied volatility. But we have another volatility called the historic volatility. And this is purely a mathematical calculation. It's just saying where was the stock 6 months ago, what was the path that it took. There's a certain calculation that we do, and we come up with a number. So the question again that we want to figure out here is, why does the historic volatility collapse when markets rise? Because if it's again the same path from A to B and from B to A, why do we get different numbers? Well, a lot of it has to do with calculation. And understand that when we talk about the volatility of a particular stock or of the market, it is simply the standard deviation of stock price changes in percentages. Now, that's not 100% of the accurate definition, but it's close enough. So if you've ever had statistics, you've definitely done standard deviation calculations a million times over. It's just a formula. And we're going to do the same thing with a long history of stock prices. We'll say the stock was up 1%, down 0.5%. That's what we're looking at. And that's going to be our data. We run it through the calculation, and that is the historic volatility. But you have to realize that when we are looking at that, the question we're trying to address is how far are prices away from the average? That'll be important. So let's take a look at a standard deviation calculation. We'll make it simple. If we take 5 numbers, 1, 2, 3, 4, 5, and the first thing we would have to do is to find the average, and that'll be right here in the center with 3. So the first thing we do is we subtract off the average from each number in the set. So if we subtract these off, we get 1 minus 3 is negative 2, 2 minus 3, negative 1, 3 minus 3, 0, 4 minus 3 is positive 1, and 5 minus 3 is positive 2. One of the steps that we have to do in figuring out the volatility is to add these numbers up. But notice if we add them up, we get 0. We'll always get 0. Why? That's an indirect way of understanding the average. If each number in the original set is on average 3, you are on average subtracting 3 from 3, and that's why you'll always get 0. So to combat this, mathematicians said, well, why don't we turn these all into positive numbers by squaring them? So we'll take negative 2 squared gives us positive 4, negative 1 squared gives us 1, 0 squared gives us 0, that's going to give us 1, and then 4. See, now we don't add up to 0. So if you add these up, you'll get 10. We take 10 divided by 5, and that gives us 2. But it's in units squared. Remember, we had to square these numbers. So we don't want our answer to be in units squared. We just want them in the original units. So if we take the square root of 2, it comes up to about 1.41, and that would be the standard deviation of these numbers. So what it's telling you is that in a roundabout way, roughly speaking, is that each number here is at about 1.4 units away from the average. That's a way of understanding it. So the first thing to understand is that when you get large deviations, it drastically throws this formula. So for instance, let's say that we threw a 10 into the mix, and in another case, we took 5 2s. Now sometimes traders would say, well, they would produce the same thing because 5 2s are the same as 1 10. Well, watch what happens when you square them. 10 squared is going to give you 100. If we square each of these, each one's 4 times 5 gives us 20. Look at that. massively bigger numbers that you're getting when you throw in one large deviation. And that's part of the answer of what's happening when you get these down days, because fear is a very powerful motivator and we get these very large gaps. And that's kind of throwing the calculation. It's creating these very large squared terms in there. And then the second thing to understand that I think most traders miss is to really how to interpret the standard deviation. So take a look at, let's expand it a bit. Let's say we've got a set of 8 numbers, and that's got a certain standard deviation to it. And let's put up another set of 8 numbers, but now we're going to put 4 1s and 4 8s. So the question is, which of these has the greatest standard deviation? Now, most traders will say it's this first set. Why? Because they associate standard deviation with variation. That's sort of true, but it's variation from the mean or from the average. So if we look at this first set, we've got a lot of numbers surrounding the average. If we look at this second set, they're polarized. They're either 1 or they're 8. So both of these sets share the same average. They're both at 4.5. But look at how much further this second set is away from the average. So if we were to calculate this standard deviation on the first set, we would get 2.3. If we did it on the second set, we would get 3.5. Now that might not look like a very big difference, but that's about 50% bigger. That's a massively large difference because we've polarized these numbers. See, in this first set, they're all equally spaced. We do have a lot that are close to the average. We have some that are not too far off of average, and they gradually get a little bit further. That's not true in the second set. It's either all on the low side or all on the high side. And that's another thing that's throwing it. So if we look at our number line, if we look at the numbers 1 through 8, so if we have another number line down here that are just made up of 1s and 8s, we had 4 1s all the way here at the left side, we had 4 8s all the way at the right. So now it should help you to visualize which of these has the greatest standard deviation. Look at the gap here away from the average. The average is right here in the center. See, again, you don't get that up here. You have a lot that are still sort of concentrated near the center. So the point of all this is that when you see stuff like this during the Corona crash, and you're going to see massive spikes in the historic volatility, and then when we come out of it, in roughly the same time, we took roughly the same number of steps to come up to the same level, you're going to find that the volatility numbers are drastically smaller. But that doesn't necessarily mean that you're out of the woods. What's causing this big drop in the historic volatility? It's on the way down, we got very large gaps. So that's producing large numbers, large squared terms, and that's just causing a very big difference from the average. But see, on the way up, the candles are not as many big gaps, just kind of overlapping a little bit. So the ride's a lot calmer in terms of the calculation on the way up. So once again, even though in both cases we went from here to the same bottom, we went from the bottom to roughly the same level up here in about the same time, those volatility numbers are going to be drastically different. So just keep that in mind whenever you're looking at historic volatilities. And if you see periods that seem to be really just hyper volatile compared to others that might have had similar ranges, mathematically, they theoretically should be the same, but it's the gaps and the magnitude of these gaps that are causing the changes in that historic volatility. And if you're not aware of that, you might think that volatility is at super calm levels when in fact it really isn't. So for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new technical analysis course. You can find it all at optionsa2z.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.